Right, today I want to talk about the downgrade heard around the world, which is Moody's stripping the US of its last AAA ratings amid fiscal turmoil. Now, for over a century, US debt stood as the bedrock of global financial security, a sanctuary asset in times of crisis, and a gold standard for sovereign credit. Now, the fortress image cracked last Friday when Moody's, the final holdout among the big three credit rating agencies, downgraded United States' long-standing AAA ratings to AA1. Now, this decision, while symbolic, carries tangible implications for financial markets, borrowing costs, and America's global economic credibility. So, why the downgrade right now? Now, Moody's rationale for the cut is sobering. The US federal government's ballooning debt and rising interest rate payments have reached levels significantly higher than similarly rated sovereigns. Now, after decades of fiscal drift marked by persistent deficits, political brinkmanship, and a failure to curb entitlement growth or increase revenues, the red flags has turned into alarm bells. Now, this is not the first time that I brought this up. I think the debt issue, I have brought it up again and again and again, and you're going to see more of it because it is something that is going to either hurt the US market in a really, really bad way, provided, something, the administration does something to it. If not, yeah, it's not going to be good for the US. So according to Moody's, the US is on track to see its federal debt rising from 98% of GDP in 2024 to a staggering 134% by 2035. Meanwhile, annual deficits are expected to swell from 1.8 trillion to 2.9 trillion over the next decade. Now, while these numbers on paper, the consequences are real. Higher yields on treasury bonds, increased interest payments, and reduced fiscal space to address future crises. So this is not something that should be taken lightly, and that's the reason why you're seeing Trump coming up with the Dodge and so on. Okay, he knows that he needs to address this issue and address it fast. Because the thing is that, when you have all these downgrades, it's just more than a symbol. While the AA1 still denotes a strong credit profile, markets have begun to price in the risk. The benchmark 10-year Treasury yield nudged upwards to 4.48% in after-hours trading. Now, I've talked about this in the previous report when we had the 10-year Treasury yield moving up and the US stock market moving up as well. At that point of time, it could be speculated that the market feels that there are better returns rather than just buying bonds and getting that 4.48%. The stock market could return better, and at that point of time, that's why you see the stock market moving up as well as the 10-year Treasury yield move up as well. But I did put a word of caution saying that this kind of relationship cannot last, because at the end of the day, high interest rates do impede economic growth, right? So what happened next was that the bond price fell, after this news was out. Equity markets responded with modest unease, with the SPDR's S&P 500 ETF dropping 0.4%. Now, the downgrade that happened could ripple across the global economy, especially if it drops more, because it raises borrowing costs for everyone from American families buying homes to foreign companies raising capital. Now, a perceived increase in risk means investors demand high yields, translating into more expensive borrowing costs across the board. And we know that almost always lead to a downturn in the economy. So what is this all about? End of the day, two things. okay, political dysfunction, and the debt spiral. Now, this is not Moody's first warning. In November, it flagged the US for potential downgrade due to escalating political dysfunction, a reference to the near default standoff in summer 2023, the historic outing of House Speaker Kevin McCarthy and Congress paralysis in replacing him. Now, despite the downgrade, Moody's maintained a stable outlook for now, citing America's enduring institutional strength, such as the Fed's independence. Now, however, that independence itself may not be ironclad. As you know, President Donald Trump has openly questioned the Fed's autonomy and threatened to fire Chair Jerome Powell, although he has lately said no, he doesn't have the power and he doesn't plan to fire Jerome Powell because he needs to project that stable outlook at the end of the day. He understands that, right? So Trump's proposal fiscal agenda only complicates the picture. While pledging to cut waste and shrink government, his signature policy, the extension of the 2017 Tax Cuts and Jobs Act, would reduce tax revenues by approximately $4 trillion over the next decade. Now, even with severe cuts to Medicaid and food stamps, the plan would add a projected $3.3 trillion to the national debt. Adding to that, the Department of Government Efficiency, or DOGE, have so far fallen far short of initial goals, right? And it is also creating a lot of that kind of stress, you know, to Elon Musk, to the point that he said, you know, he's going to actually step down due to the to spend more time in Tesla. Okay, so at the end of the day, I would say in essence, looking at all this, the government would be spending more while earning less. That to me would be the conclusion for all this, right? Other than that, the what you call the global trust is on shaky grounds as well. Foreign demand for US treasuries, once insatiable, is softening. The ever-growing pile of US debt needs constant refinancing, but fewer global investors seem eager to hold it. And a downgrade by a prestigious agency like Moody's only fuels those doubts. Okay, so going forward, I think the majority of the bond would be actually gobbled up by the US itself. Okay, recent geopolitical shifts such as new tariffs on imports and rising multipolar competitions also weakens Americans' financial magnetism. The US dollar may still be king, but the question right now is, but for how long? Okay, now this is not something that's going to go away. You know, the US dollar is not going to go away overnight. It will take some time. But now the question is, for how long? So what this means to the everyday American, all right? So the impact of this downgrade will ripple into everyday life. Treasury yields are foundational to mortgage rates, car loans, credit cards, and even student loans. So if investors demand more return for perceived US risk, households will feel the squeeze. Moreover, high interest rate payments by the government means less spending on infrastructure, education, and social services. So as a conclusion, Moody's downgrade is not merely a slap on the wrist. This is a seismic signal. The world's largest economy is on an unsustainable fiscal path, and the political will to reverse course appears elusive. Now, there is hope, you know, that the Donald Trump might address this, right? But it's not going to be easy for him because he has his other agendas as well. For example, the one big beautiful bill, Trump's centerpiece legislation, may win votes, but it risks accelerating the country's fiscal decline unless he could, you know, everything falls according to his plan. But that's not, like I said, that's not going to be easy. The America's financial credibility built over decades is no longer inaccessible. With all three major credit agencies now unified in their warning, the message is clear. Without genuine structural reforms, even the world's financial superpower can fall from grace. So the question now is when Washington will treat it like a bombshell or simply move on until the next downgrade comes knocking. Now, this is something that, like I said, we need to really look into, especially with the bonds making a new swing high. The high of the bonds as of today, it has reached 4.564% already. Now, if this continues to climb, it's going to be really bad for the US, and something will happen. Nevertheless, if the US is able to survive this, then the market could continue to move up higher after some correction due to this thing. But every single high is going to be viewed with a tinge of skepticism unless we see changes in the interest rates. Okay, this is also why Donald Trump is so persistent in asking Jerome Powell to cut rates, because when you do that, it can help him in his goals. Okay, but as you all know, the Fed is an entity on its own, and they don't report, to listen to the president, but because they have their own agenda how to take care of the US economy. Okay, namely inflation and employment. Okay, so with that, that's a report for today.